An insurance company and a bank are showing signs of growth and income. And our growth and income strategist, Todd Bunton, is here to tell us more. The insurance company is Maiden Holdings, not your run-of-the-mill insurance company, a specialty insurer.
That's right, yeah. And what's interesting about them is that they're considered a reinsurer, which is basically an insurance company, an insurer for an insurance company.
Okay.
But yeah, they provide non-catastrophic lines of insurance, like workers' compensation, where the losses are fairly predictable.
Right.
There's no huge, major losses quarter to quarter, because of weather-related events. No exposure to that.
Not a lot of unmanaged exposure.
Exactly, yeah.
Yeah.
And that leads to more stable, predictable earnings, and that helps them pay a very solid dividend, which I'll get to in a minute.
Okay.
But the company delivered solid earnings on November 5th. They saw earnings increase 23% year over year. That was driven by strong premium growth and also strong growth in their investment portfolio, strong net investment income. And it prompted analysts to raise their estimates higher for both this year and next year, which sent it to a Zacks rank of 2, which is a buy rating. You can see with me here a nice bump in consensus estimates over the last 7 days. That was driven by the solid third quarter results like I talked about. If you look at consensus estimates, analysts are expecting good double-digit growth for this company over the next couple of years as well.
Yeah, I see that.
Yeah, so as they continue to grow their premiums written, and that you can expect that those stable loss ratios and also strong net investment income as well. So that should drive earnings for this company over the next couple of years. And in addition to that growth, you're getting a dividend that pays 4.1%.
I thought I heard the D word there earlier.
Very solid dividend from a small cap company like this. They have a market cap under $1 billion, but very shareholder friendly here. They actually recently increased their dividend by 18%. And if you look back over the last 5 years, they've increased it at a compound annual rate of 15%. So very good on the income side. And like I said, that dividend is pretty safe here because they're not going to have huge losses one year where they're going to have to cut their dividend to shore up their balance sheet. There's really not exposure like that here. So that's an attractive characteristic here. And also the valuation's attractive too. They trade at just 7 times forward earnings and 1.3 times tangible book value. So there's some good value to go along with the growth and income metrics here. The one caveat with insurance companies is, as you pay your premiums into insurance companies, they tend to invest that in fixed income securities like bonds. So they do have an investment portfolio heavily in fixed income. Well, the problem with that is in a rising rate environment, the value of those bonds drops. But I would say the exposure here is relatively limited for them. So the duration of their portfolio is less than 5 years, which basically means that their interest rate risk is fairly low. So there's a lot to like here.
All right, the other is a bank, CNB Financial Corp., better known as on the street as CNB Bank.
Yeah, that's what our listeners or people watching in Pennsylvania would know it as, the CNB Bank. They also have Erie Bank, which together has 28 branches in Pennsylvania. They also own FC Bank in Central Ohio, which has about 9 branches.
Okay.
But this is a solid little community bank, very shareholder friendly as well. They pay a very good dividend, which I'll talk about in a minute. But you're seeing solid fundamentals improve, solid improvement in the fundamentals at this bank, and that was on display last quarter. They delivered solid third quarter results on October 21st. Results came in above the Zacks consensus estimate. They saw strong fee income, strong efficiency ratio, which measures non-interest expenses, and credit quality continued to improve for the bank, which prompted analysts to raise their estimates after that quarter, sent it to a Zacks rank of 2, which is a buy rating. And again, analysts are expecting solid growth from this company over the next couple of years as well. So good growth here, good dividend. Like I said, they pay a dividend that yields 3.7%, which is very solid for a small cap bank like this. If you look at the chart, though, they have held that dividend steady since 2009.
I was just looking at that. Yeah. It's interesting.
Yeah, a lot of banks have started to increase their dividend, but a lot of banks also cut their dividend during the Great Recession. You can see here, going back to 2004, they did not cut their dividend during the Great Recession, so that's definitely a positive. But you'd like to see now that their fundamentals are improving, credit quality is improving, solid loan growth, and all that good stuff, that they would start to increase their dividend. And I wouldn't be surprised to see a dividend increase in the next year or so from this company. But you're already getting a 3.7% yield, so that's very solid as well. Can't complain. And the valuation picture looks attractive. They trade at less than than 12 times forward earnings, 1.7 times tangible book value. So there's a lot to like about this bank.
All right, do you own either one?
I do not.
All right, check out other stock picks, stock picking strategies, other articles on stocks written by Todd, too, on our website, Zacks.com. If you're watching out in syndication, get on over to the homepage, link to it all from there. With Todd, I'm Terry Ruffalo.